Hello, everyone. Thanks for tuning back in. Hey, today's video is going to be a follow-up to a video that I did just the other day about what's going on in the real estate market. Is it a good time to buy? Is it a good time to sell? Been getting a lot of calls from friends, family, and clients about that. Today, I'm talking with my lender, Mike Weisberg from Lend to America, on what he's seen going on with interest rates. Where does he see them going? What type of loan programs are even out there for buyers right now? There's a couple of new programs that can actually help you jump back into the game if you've been priced out. So make sure you watch this video. Some good stuff on it. And hey, listen, if you like what you're hearing right now, please hit the subscribe button down below so that you can be notified of future episodes. Feel free to reach out to us. We've got a Calendly link down below as well that you can book a 30-minute Zoom or an hour Zoom meet with us. We'd love to chat with you and see how we could be of service for you guys. All right, thank you very much, and we'll talk soon. All right, everybody, I am back again with my number one lender over here, Mike Weisberg from Lend to America. Mike, how are you?
Tom, thanks for having me.
Of course. Hey, Mike, I did a video the end of May, sent it out to all my friends, family, colleagues on what was going on in the real estate market. Is it a good time to be a seller? Is it a good time to be a buyer? Everybody's kind of with these jumping interest rates are just kind of scratching their head going, man, I don't know what to do. Let's just jump right in. Mike, interest rates, what the heck happened? Why,
Yeah. Well, so let's put this into perspective. I've been doing lending for 30 years. When I got into this, I saw people with rates at 9 and 10%. And those people I refinanced down to 8%, and they thought that was the best thing ever. So in the global spectrum of where rates are, they're really, really low still.
Yeah.
That being said, yes, in the last few months, we've seen rates going higher and higher. And so we could talk about why. The underlying reason of what's pushing rates higher is the inflation numbers. We've been seeing inflation going up. Obviously, the pandemic has created a different atmosphere than we've ever experienced before. And with the government infusing a lot of money into the economy, it's created some supply shortages and it's caused inflation numbers to go up. Obviously, we've seen gas prices and cost of goods. Everything's more expensive. And so now the idea is, well, if we increase interest rates, that would ease some of the pressure by slowing down things because maybe it's more expensive to buy stuff and do things and make it adjust the pricing. That's the theory behind it. But yeah, we've seen rates where we got down to 30-year fixed rates got down to like 2.5% during the pandemic. It was, amazing to see. We never expected rates to be that low. And now we're seeing rates in the low 5% range.
Right.
So that's a big jump in a few months.
You mentioned slow, and interesting that you say that. They raised the rates to kind of slow home buyers from getting out there and buying homes, because I guess the thought behind that is when they buy homes, they go to Home Depot, they hire contractors, they buy things to fill their homes up. And their thought by doing that is to less homes being sold, less things happening, kind of slow the market down. So their need for these goods would slow down to give the supply chains time to kind of replenish the stocks or something like that. Is that kind of the idea?
Yeah. And when you think of it, it's kind of, you think it's almost counterproductive. You want money to be out there in the economy. You want people to be buying and spending and employing more people to build things and do things, because the idea is you want your dollar to leave your pocket, go into the next person's pocket and the next person's pocket, and everybody's getting a piece of that dollar versus raise interest rates and put a freeze on that a little bit. Now my money is not leaving my pocket. That then means less buying, less goods being built, less employment, of people to build those things. So sometimes these things can have a rippling effect where you're trying to get something in control, and the knee-jerk reaction could be, people don't, the big R, the recession, does that put you into where are we heading if this goes to a different level without it being controlled? From what I've seen for interest rates, and I won't preach to be an economist, for the whole economy and everything that goes beyond it. I mean, it's interesting to hear, an omission from the Fed Reserve, Janet Yellen this past week, talking about not expecting what had happened and miscalculated the reaction of what they did last year. That's a big step. I mean, and these are very, very bright people, the brightest of the brightest running the country, saying we made a mistake. On a mortgage standpoint and on interest rates, what I do see is a stabilization. I don't think that we're going to see these rates go from where we were at 2.5 to where we are in the 5s to go to 7 and 8 and 9% over the next couple of years. I just don't see that. I think that really puts the brakes on everything. Housing really is something that catapults the entire economy. So, it's not just buying a house, but as you said, it's the people at Home Depot. You want to improve your house. You want to build a house, all these other, pieces that go into that. So what I would predict is that we probably will see a stabling between 5 and 6% of a leveling of rates, which is still historically very low. Your payments are going to be a couple $100 more a month.
Yeah.
It's not thousands and thousands of dollars more, but it is going to be a few $100 based on our average, $800,000, $900,000 purchase price home. It's going to be a couple $100 more a month. And that's the comparison. Is it still worth, for somebody that's looking to buy, is it still cheaper to, rent or own at that point?
Right. I think this bump in interest rates also affects more of the short-term credit cards, right? Car loans, credit card loans, HELOCs, all these other things. So it's also put a slowdown on people so quick to pull out their credit card to buy something. And also their car loan that they were getting at 4 or 3% or something like that's now going to be 7%. So I think it's causing a slowdown in other areas. And I don't know. I mean, I'm just kind of like scratching my head going, you would think you would want more homes to sell and keep the economy going. But I guess these brighter minds, they know something more than I do. But I'm glad that you shared about where interest rates will level off at, because I think that's everybody's big fear is, are they going to go to 7 or 9 or 8? And, you get on one podcast and you hear one thing, and you get on one guy's, TikTok and he's saying something else. So to kind of hear somebody who's in the trenches on what they're seeing and what's going on and stuff like that, I think is really valuable to kind of get a calming knowing. I know us in real estate, we've talked at all our Keller Williams conventions that a flattening of our real estate market would be amazing, just to see home values just level off at 700 or 800 for the next couple of years would be awesome. We don't necessarily see a dip, but just a flattening. These 7% a year gains are just they're not weatherable. It's
right.
only gonna cause that crash. And I think it just seems like rates overnight went from 3.7 to 4.9 to 5.5, like
right.
Bam. And and a lot of the clients I'm talking to is like sticker shock. They're like walking around going, wow, what happened? And I think for the most part, people here in LA, they make good money. They have stable jobs. So it's not like they can't afford the bump in mortgage. It's just that sticker shock of, man, I could have owned this home for $3,600 a month, and now I'm owning it at $4,200 a month. And
right.
and like, man, I gotta figure out where do I jump in at,
Well, and it's interesting to say that because, a lot of the forecasts, like you said, most agents would love to see a flattening of the market, but for the next couple of years, the majority of the forecasts are an increase in home appreciation, not a decrease, not double and triple digits, but maybe this year it's 10% and maybe next year it's 7% and kind of fades down. So here's the thing. Do you buy now at the price that it's at and take a rate that's at 5.25 right now on a 30-year fixed? Or do you think that next year it's going to be better and now you go buy that house, even if the rate's the same, okay, but or the rate's gone up, but the house hasn't. So let's just say the house price is now the same, $800,000 house it was today, it's $800,000 next year, but the rate has gone up 0.5%. What did that cost you? And I'll tell you, over a 30-year period, that is a lot of interest.
Right.
You know, I mean, if that's a $300 payment a month, you know, that's $3,600 a year over 30 years. That's $108,000 you just paid more for that house because of that bump in rate by 0.5%.
Wow.
So, you know, ideally you want to, you know, the timing, if anybody goes, I'm just going to try to time the market at the perfect time is now. If you have the money and you have the ability to do it, and especially if you don't own and you're renting, because one thing is when you buy a house and it's a 30-year fixed, your payment is locked in.
Right.
That's a 30-year fixed payment. You go rent, it may be fixed for a year, you know, if you got a 1-year lease, but the trend is that rents are going to go higher, especially in our LA markets, because there is a limited concentration of homes. You can't build much more. There's no more dirt available to build.
Yeah.
So, you know, they're just going to keep pushing up the rates. So you can at least control your housing expense by owning a home.
Yeah. And if you decide to rent for cheaper, it's going to be in an ADU behind somebody else's house, and you're going to get half the square footage and wake up to see your neighbor every morning, you know, your guy sitting there waving at you every morning as well. So I agree with you. It's definitely a good time to be a buyer right now with these interest rates. And like you said, the limited amount of homes, there's no more dirt out there. You know, I was looking at this economic forecast and they were saying 55% of Californians own real estate right now, which is a great number. And over half of them have like significant amount of equity still in their home. So this whole vision of the market crashing or people walking away from their house is just not going to happen either, you know?
Right.
So
for sure.
You know,
yeah, we're in a different market, you know, which it's nice. I looked to the last turn markets, you know, in 2008 and 9, and that was devastating. There was a lot of different bad loans in the market and other things that had a real rippling effect. Yeah. You know, this time around, we've got people, as you said, a lot of equity in their homes, you know, a lot of upside. So, you know, it really gets down to, you know, if you don't own, is now a good time to buy and stop renting. And yeah, rates are still really low. Yeah. I mean, 30 years of doing this, I always keep saying when I see these rates, when I saw the rates go to 3%, I'm like, wow, we'll never see that happen again. And then we had a pandemic. Who would have expected a global pandemic and rates to go to 2.5%?
Yeah.
You know, but I can pretty much say, at least in my lending career, I don't think I'm going to see 2.5% rates again.
Yeah.
If you're waiting around for 2.5% rates, forget it. You know.
Let me ask you, so you think that if this whole slowdown of the economy happens, maybe it comes to a halt, like they raise them so high that everything just, you know, 90 days from now, it's like, you know, wouldn't easing the rates be a great way to speed it back up?
Well, sure. But here's the thing. So rates are determined, mortgage-backed securities are really where interest rates are derived from. And then the banks add on to that for their profit margin.
Right.
What I can tell you, during the pandemic, when we saw rates down to 2.5%, if the banks weren't in the middle of their profit piece of that, of setting those rates, we probably would have seen rates at 1%. Okay. It was that low that we should have seen, what happened in Europe, some things like that, where it was negative rates and stuff happening. So right now we're seeing rates in the fives. Yeah, maybe they should be upper fours, but the banks are holding out. And think of the banks like Vegas and the house. They always want to win, they don't lose in Vegas, That's why the casinos are so big. It's kind of the same thing with the banks setting the rates, is they're not going to lose. So they don't want to see a less volume, less activity of loans coming in. So they will soften rates wherever they can to keep that going. Then the next thing that happens, which we're seeing a big change right now, is adjustable rates. Something that, somebody's willing to take a little bit of a risk because maybe they think rates are going to go down over the next few years. Well, wait a minute. Why not take something fixed for 5 years or 7 years or 10 years? That's going to get you a rate, instead of in the fives, it's going to get you a rate in the fours. That's, now you're sitting there going, wait a minute, rates in the fours, that's not that far off from the lowest of the lows anyway.
Right.
And, you're good. You're set for 5, 7, or 10 years. At that point, at the end of it, it could adjust, higher, sometimes as high as 5% above that starting rate. So that 4.25 could go to 9.25, but it won't happen the following day. In 5 years, it'll take 5 more years to get to that maximum. So think of it as almost like a 10-year loan.
Gotcha.
That has a maximum cap, because it's going to limit how many of the first adjustment, no more than 2% over that 4.25. So maybe it goes from 4.25 to 6.25, then to 8.25, and then to 9.25, something like that. So it would take, about 9 years to get to the max. But it definitely gives an option for somebody that thinks that maybe rates are going to go lower, or that they're not planning on being in that house that long.
So that might be a great product for somebody that might be a little priced out of the market right now, because at 5.5, their debt to income ratios just don't, they've priced themselves out. But if they could take one of these short-term loans, or a 30 due in 5 or a 30 due in 7, where they're going to offer them a teaser rate, that might put a lot of people back in the game to afford home ownership right now then, yeah?
Correct. Absolutely. So, and the terms that you're going to hear are 3-1, 5-1, 7-1, 10-1.
Okay.
And the 1 means it can adjust every year thereafter. If you say a 30 due in 5, truly what that means, it's a 30-year amortized loan, but at the end of the 5 years, it's due.
I got to pay it.
So it's paid off. So, you'll hear like ARM's 5-1 or a 5-6, meaning it could adjust every 6 months, or it's every year thereafter. But these are going to be tied to, LIBOR's, London Index, Treasury Index, different indexes that'll vary where those rates could be. It's an index and a margin. You add those together, that would determine what the rate would be down the road. It's a little bit more of a sophisticated loan, so you definitely want to take time when you're getting that type of loan to get fully explained of what the payments are, what the maximum payments can be. But yes, it will give you more buying power because you're getting a lower interest rate. And that's going to help you increase your purchase price for your qualifications.
What are the down payments for something like that?
Oh, we've seen them as little as, 10% down.
Oh, okay.
On some of these are about 10% on average.
So if I've got 10%, I can definitely see about one of these ARM adjustable rate mortgages to help me get in there. I think that would be good for somebody too who's upwardly mobile, who knows that their future is going to have more income coming in. They may be working their way up a corporate ladder or graduating and getting into, they're moving their way up. They know their income's going to be better. That might be something that would be perfect for somebody like that. Yeah.
Yeah. And then there's, taking it another step, because the banks are getting creative as volume, drops a little bit with these higher rates, they come out with new programs. So there's even now basically no income documentation for primary residence. So you literally don't have to show a job or your income amount to buy a house.
Cut it out, Mike.
I know you have to put a down payment down though. So it's not like you're going to get away with anything, but it is going to be at least a 15% down, but all the way up to $3 million.
Wow.
So you could literally go out and buy a $3 million house, 15% down. They are going to look for really good credit. They're going to look to see that you have plenty of money in the bank for reserves to cover payments for a year, 18 months, so that they know that you've got a lot of money and you've got skin in the game. You've got at least 15% down.
Gotcha.
But these are programs now that they're not even requiring income verification or employment.
Wow. I'm a little nervous on that one. What do you think, Mike? Why would they bring that out?
Here's the difference that I see, though, is most of those programs back then had no skin in the game, meaning no down payment.
Yeah.
There was a 80% first, a 20% second. It was 100% financing. They were going down to 620 credit scores.
Yeah.
It was really just, if you had a pulse, you got a loan. Kind of
Yeah.
So this is, you got to have a good credit score. You got to have assets. You got to have money putting down plus money left over in your bank. So there is some more, so to say, skin in the game, and at 15% in it, nobody's projecting a 15% decrease in the market. So they figure that if somebody, for any reason, did get in trouble with their payments, they would have an out. They could sell it and they still have equity in the home to get out of it. They wouldn't lose the house.
Because I guess on an $800,000 house, that's probably over $100,000 that you're dumping into that house.
Yeah,
Good
120.
chance. Probably not walking away from $120,000 and giving that loan back to the bank, saying, here's the key, see you later. You're
not when they got you out there that could sell it for them and probably make money on them.
I love it. Thank you, Mike. That's awesome. So I guess to recap real quick here on this video is you kind of see a stabilization in interest rates, maybe topping out around the sixes. You don't really see them going into the sevens or eights right now, based upon the data that you're seeing today, which is June of 2022. And there's some good product out there right now as far as the adjustable rate mortgages that can help somebody still get a 4% rate that might have been priced out. They could bring these people back into the marketplace. And this other, what's the rate on this third loan that you talked about, the stated income? Is that the big surprise?
You're probably looking at in the 7% range.
Okay. Gotcha.
You will pay a premium for it.
Gotcha. But that might be a loan that might be good for a couple of years just to get them in as they get their affairs in order and stuff like that. And then, refinance onto something like that. So it's probably not a long 30-year keep loan, but it's something that can get them going and stuff like that.
Absolutely. It's getting you into the home. And then there's options once you file tax returns and show higher, income numbers, then we can refinance you out of that.
Gotcha. Mike, have you seen refi slow down or anything like that?
Well, sure. I think over the 2-year pandemic, 2.5-year pandemic, we were, hand over fist. There was so many people coming in to refinance that everybody that could qualify pretty much already did refinance. So I think right now what we're seeing of refis are purpose-driven refinances. It's taking cash out for home improvements, adding on accessory dwelling units, paying off credit card debt, which is a big thing, or the unfortunate things of, divorces or other things like that. So it's specific reasons that the cash outs are happening or the refinances are happening now. It's not generally, hey, I want to refinance to a lower rate. Maybe it's I want to get rid of mortgage insurance because I've got equity, or I was in an FHA loan and I want to go into a conventional loan. So specific reasons, but it's not the typical, hey, I bought a house, 3 years ago and I want to refinance now. Those people pretty much took advantage of that already.
Got it. Hey, Mike, thank you very much. I think we touched on all the topics. Any closing thoughts you have?
No, the last thing, I would say is, especially, we talk about purchases, but on the refinances, there is a lot of debt out there these days. And, what people don't look at on these credit card debts is, they can be 21% interest rates on these credit cards. They may look at, oh, it's a minimum payment of $150 a month, but with no hope in sight of getting ahead of that. I mean, if you own a home and you've got equity based on the market right now, even with a higher interest rate than you may have gotten 2 years ago, if you get rid of all of this credit card debt, I mean, you could be, who knows, $1,000 or more positive every month, in your pocket of cash. Yeah. So, there is definitely a lot of debt out there. People need to do something to get ahead of the game. And that is a game changer, is to tap into your equity while you can.
That's awesome, Mike. If people wanted to reach out to you, maybe consult with you on something like that, you're always around, yeah?
Absolutely. You can always call me on my cell, and that's area code 805-444-4294, or visit me online on our website, www.lendtoamerica.com.
Amazing. Hey, Mike, thank you very much for your time today. I really appreciate it. I know our viewers are going to get a lot of good stuff out of that, and hopefully you'll hear from them soon. Yeah?
Thank you, Tom. Appreciate it.
Mike, let's stay in touch.
You're welcome.
Bye-bye. All right, that was my interview with Mike, where we talk about the market and what's going on, where he saw interest rates going, and the different loan programs that are out there. So adjustable rate mortgages are back in play, and now even a 15% down stated income program is out there for you guys. So listen, if you guys can afford to make the mortgage payment and you're renting right now, it is definitely a good time to be a buyer. There's less competition out there. We all know that based upon the limited amount of inventory, prices are probably going to stay pretty stable. We don't see them adjusting down too much. So the question becomes, do you want to be a borrower at 5.5%, or do you want to be a borrower at 6%? The decision's up to you. We're here to help you in any way. Feel free to reach out to us. We'd love to chat with you. All right, guys. Bye-bye.